If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
Hey, Mark, welcome to the show.
Thanks, Shawn. Thanks for having me on.
Hey, no, thank you for joining us. I know you're a busy guy, so really appreciate you taking the time to come on here. I'm excited about this one. We talked about some things before we got on here, and I'm really excited to jump into this. But before we get into that, everyone loves a good origin story. So if you don't mind sharing who Mark is and how you got to where you are today, that would be great.
Well, I'll take you further back than you probably expected I'd go. I'm 5 years old with my mom, hand in hand, walking to a bank. I've got my paper bag in my other hand with about $50 in it. Change, loose change, dollar bills crumpled up. It's basically my life savings from all the allowance money and whatever, lemonade stands as a kid. And I was a little trepidatious because I was about to walk into this strange building and open up a bank account. And what that meant, as I came to find out as a little naive 5-year-old, that opening a checking account meant handing over my life savings, everything I had ever worked hard for, sweat, blood, and tears as a 5-year-old, to this total stranger who claims he's going to put it somewhere safe and I can come get it at any point I want. And I was thinking to myself as a 5-year-old very clearly, I was like, I already had that back in my house, and it was in the sock drawer. Why do I need to put it at this strange building? What's he got for me that I don't got in my home? And, little did I know that it might have been even safer in my little paper bag than at the local bank. So that's my first experience with money and banking. Fast forward a few years, and I'm now 6 figures in student loan debt and have absolutely no clue how to pay it all off and really no desire to really focus on it. But now I've got a major commitment now to my financial future. And I'm graduating with my master's degree in 2008 with basically a non-marketable degree in the midst of the greatest financial crisis ever. So talk about a great start to life, right?
That sounds fun.
Yeah. My wife and I jokingly say I married 2 women in college, my beautiful wife and Sally Mae, who's along for the ride. So that's sort of where things started. I ended up getting so focused on our own financial strategies that I got my certified financial planner designation, which is kind of the superhero cape that is invisible behind me, because I certainly didn't grow up knowing any of this stuff, but it's been a true privilege ever since to work with people over Zoom and over the phone in all 50 states to set up real solid financial strategies that help them get rich, not get rich quick, but get rich for sure.
That's awesome. Well, it's impressive. $50 as a 5-year-old. To me, that's impressive. I don't remember that I had that much money back then. This your second wife, Sally Mae. The only downside to that is you can't divorce her no matter how bad you want to. So
that's right. You got alimony for as long as you are on the dole for her. But thankfully, we did get rid of her, and she's on her way to harassing other people now.
Great. I know that's a whole other conversation you and I could get into right now, and we won't go down that rabbit hole. But listeners, I do have an episode on this, on how to pay off your student loans faster. So yeah, if you want to go check out that episode on how to pay off your student debt faster, or any type of loan that's similar structure to a student loan, go to episode 22, how to pay off your debt faster. And I know Mark has a strategy for this as well. So Mark, feel free to share that as well.
Well, most people who are in debt might know about the phrase, the debt snowball method of paying off your debt. It's the idea where you list your debts a few at a time and you knock them out, smallest balance or highest interest, whichever you choose. I was doing that at the beginning, but I quickly realized that was not the most effective way to pay off my debts. Mm-hmm. It may have been the fastest, and that's fine. Fast is good. But I also realized that pouring money down the throats of the bankers was making them wealthy while sacrificing the most valuable dollars I'd ever have in my pocket. What are those most valuable dollars? It's the money you have right now at your youngest. You're as young as you'll ever be ever again, meaning you've got the most time to compound that money in your pocket right now that you'll ever have for the rest of your life. And so by forfeiting that money, by pouring it into somebody else's pocket, you're helping them succeed in their financial goals and, losing the opportunity to see that money grow. It's opportunity cost. So, we can talk further about this, but we went ahead and trademarked the concept, the debt snowbank method, for paying off your debts, whether it's student loans, credit cards, mortgages, whatever. And it helped me and my wife pay off all that student loan debt and become better than debt free. In fact, it gave us 6 figures of now compounding assets that we would have had not had had we paid off the debt the old fashioned way.
That's amazing. Yeah. If you don't mind going a little deeper into that, I'm sure the listeners would really appreciate it.
Sure. Yeah. Well, and this matters no matter if you're in debt or not. The truth is, guys, you finance everything you buy. Everything you buy. And you either do it through paying interest to a bank, credit card, finance company, mortgage company. And that's pretty typical. And the average American spends about 37 cents on the dollar to service their debt. Let that sink in for a minute. If time is money, what's 37% of your day? Just working as a slave to a bank. Okay.
Yeah.
So the other side of it though is, hey, Mark, I'm going to be smarter than, all these financing rackets. I'm going to just save up cash in my paper bag or my bank account and go pay cash for that car or that real estate deal or whatever, or pay off my debts with cash. Well, that's fine. But what are we doing? We're still financing, aren't we? Because we're stealing from our future self when we pay cash for things. When you pay cash, you stop the growth on that money. The interruption of compounding is the worst thing you can do in a financial plan. In fact, Charlie Munger says the first and most important rule in your financial life is to never interrupt compound growth. Charlie Munger's is the buddy of Warren Buffett, as you know. So I would say that you do finance everything you buy. Either you pay interest to a banker or you pass up interest you could have earned on that money had you left it invested instead. And so the trouble is we're always trapped on net zero. It's like a gravity force that keeps pulling us back down to net zero. But using the debt snowbank method, you're able to lift off from zero and continually compound that money, even while you have liquid access to it for things like cars, real estate, but also for paying off debts. This is truly, for me, a revolutionary way to become debt free. And so that's what we call the debt snowbank method. I can kind of walk you through those steps if that'd be helpful.
Yeah, definitely. And I love this topic. I've actually talked about this multiple times. One of the most common, questions is, do I pay off my mortgage or not? And, it's all relative. First, it's, what's your risk tolerance? Is it really going to keep you up at night? But beyond that, what are your rates? And if you haven't refinanced, if you have a high rate and you haven't refinanced, you should look into that because rates are at all-time lows. But assuming you have an all-time low rate, why would you pay off your mortgage? It's fixed debt for 30 years, let's say, and you have sub 3% interest rate. Why would you pay that off? Because you can go take the money you would, like Mark is saying, that you would have used to pay off that mortgage and go invest it. And in today's market, you're gonna make more than 3%. And so that spread is how you're making money and building wealth while paying down that debt. And then the power of real estate, rental real estate, is even more powerful because someone else, your tenant, is actually paying that debt service, that mortgage payment for you. And one, paying down the debt, but two, building equity. Well, then you can go take that money and either go invest it somewhere else or invest into a new property. So to me, I love that you brought this up, Mark. It's super powerful. And this is how true wealth is really built. And yeah, please go ahead and explain those steps.
Well, you're bringing up a great point, and you're showing critical thinking skills, which is so important for our financial life. To follow some sort of baby steps formula without critical thinking, I think is going to leave us, in baby steps. And while those are fine, but most of us want to run a marathon, right? I don't want to just be stuck doing baby steps for life. I want to really make a difference in my financial future, my personal finances, my family, my legacy, the world, if possible. To really make an impact, you got to do more than just, follow a little recipe of baby steps from some guy you heard on the radio, who shall not be named. Okay.
Right. We all know who you're talking about.
So, all right. So here's the steps. Yeah. Right. Yeah. Here are the sequence of events that happen with a debt snowbank method. Okay. And it's a different way of thinking. It's just like you said, it's thinking about your life as one wallet, because you might pay sub 3 on your mortgage and then get 7 or 8 or 10 cap rate, whatever you can find in other investments. And that is a net positive for you. And so not all debt is bad. So to your point. Now, so here are the steps you might say as we get into the debt snowbank method. First, you still want to pay the minimums on all your debts. So we're not going to go behind on any debts. That's, hopefully clear. We want to stay good for credit scores, et cetera. But the next step of the debt snowbank method differs from the snowball method. And here's how. With the debt snowball method, the typical way to pay off your debt, anything extra above the minimum payments, Shawn, would be poured into a debt, one of your buckets of debt, your credit card or your medical expense, whatever. On the debt snowbank method, our new way of thinking about debt payoff, instead of pouring money into a banker's pocket, you're going to pour it into your own bank pocket, you might say. In essence, it's like a bank, but it's not using a FDIC bank account or a brokerage account or a real estate deal. It's using a specially designed form of dividend-paying whole life insurance. Of all things in the financial universe, as a certified financial planner, I never thought I'd be on a podcast talking about whole life insurance, for goodness sakes. There's way more sexy things to talk about, but I got to say, as a fiduciary and as a certified financial planner and someone who's done this now with thousands of clients across the country, I cannot look past some of what these policies allow us to do. So before I move on with the snowbank method, let me quickly explain what is whole life insurance. One, it grows on a guaranteed basis every single year. Two, I have liquid access to that money with no taxes due if I designed it correctly. Three, it continues to compound and grow even when I access the money. To say that another way, even if I touch the money, even on the capital I borrow, the policy continues to grow as if I never touched a dime of the money. And then finally, it is life insurance. So I'm leaving my family a legacy that probably they'll be happy about as well. So those are the four things. Now back to the snowbank method. When I pour extra money, anything I don't need to service my debt with, if it pours into my bank on yourself designed, we call them bank on yourself designed policies for short here. If it goes into that policy, it's building a liquid pool of money by which I can then access to wipe out my debts one at a time. Okay, so imagine two piles of money. You've got your big pile of debt. And at the beginning, anyway, your whole life policy, your bank on yourself designed whole life policy is going to be relatively small. But as you flood that policy with tons of capital, this could be a couple $100 a month or a couple $100,000 a year, your call. But the more you pump into that policy, the more you've built up a sizable equity for yourself. So imagine your big pile of debts coming down slowly while your whole life policy cash value is accelerating rapidly. And one by one, you're able to use your whole life cash value like a line of credit as collateral to wipe out those debts one after the other. Now you've not paid off the debt, you've just bought it back. You've bought it back from your banker, your Capital One card, your mortgage, your high interest credit card, whatever, your private money lender that's charging you 8, 9, 12%, whatever. Now you've bought that back. I'll tell you a quick story and then we can wrap up Debt Snowbank if you'd like. A gentleman who's a photographer, a client of mine, just a photographer, right? Not exactly a 7-figure in business or whatever. He was just getting started right out of college, photography business, but he was really wanting to get into real estate investing. And he had put some money into a whole life policy and he borrowed against it to put the down payment down on his real estate deal. So that's pretty cool. All right. So awesome. He had saved enough to do that. That is awesome. Now, remember, the policy is continuing to compound. And then he's using the rent money from that 8 unit that he bought to pay off that policy loan that he borrowed against his policy. How did he buy the rest of the 8 unit? He used a private money lender who was charging him 12% for the privilege of being in debt with him. Okay. So he built up enough money in his whole life policy that he bought out his private money lender. And now he lends money, private money lending. This little photographer guy is now the private money lender to other real estate investors. Wow. With the policy that he set up, not long ago, 8, 9 years ago. For him, that's not too long. And just talk about moving upstream financially, Shawn. You just go from, wage earner to entrepreneur to real estate investor under the thumb of a private money lender. And now you're banking on yourself. He's banking on himself. And now everyone else is banking on him too. I just think that's a truly remarkable transformation story. So why don't I hush for a minute? Story. Yeah. What questions so far on this strategy?
Yeah, I know this is probably a loaded question, and you don't necessarily have like a clear answer per se. I think it probably depends on the situation. But when you're talking about like the cash value based the total value of the plan, is there like a kind of like a rule of thumb type of ratio? Like how much can you generally have in cash value? I know it grows over time, but say you put in 100,000 the first year, what can you usually have access to within maybe that first year or second year?
Yeah, good question. Depends on how it was designed, depends on age and health. It could be anywhere from 70 to 90,000 available in
Yep,
cash, liquid
that's
for you to
powerful.
purchase. Yeah, it
But that
is.
that 100,000 is still growing, even though you might have taken that 70 to 90 out, which that's to me,
Hmm.
that's the powerful part. 'Cause then you put it to it's essentially working for you twice. So it's
Hmm.
working for you if you go to take that money and invest in something else, it's working for you in that investment,
Sure.
maybe a
Yep.
piece of real estate, stock, whatever it happens to be.
Yep.
And then
Yep.
two, it's working for you within the whole life plan as well. So that's that's how you can grow some real wealth real
Yep.
fast, and then also have that benefit for your family in the future. And that's just that story is so cool too. He went from photographer wanted to get into real estate. He did his first deal through the whole life policy, and also from using private lender, private money to fund the rest of it. And now he funds he uses his money to fund deals. That
That's
is
right.
comes full circle. That's really cool.
Yeah. Well, we're just full of incredible transformation stories. I can give you one more if you want,
Yeah, that'd be great.
as we kind of think about it. So, we have another real estate investor he's 45, and he was putting in a annual lump sum of about $32,000 a year into a whole life policy. And at 10 years, I'm looking at his numbers right now. After 10 years, he had almost $400,000 of cash value and a $2.1 million death benefit. Okay.
Wow.
So he decides in year 11 to borrow against that policy $350,000 to make a large lump sum into a policy, or excuse me, into a property where he's going to get some cash flow, large apartment building. And he also sets it up as a syndication, so he's going to hopefully get out of it in 4 or 5 years. The policy continues to grow, and he's no longer paying into it. So he has stopped at that point. He stops putting any premium into his policy. And from year 11 through 12, 13, 14, 15, he's paying back the loan with rent money and so forth from the passive income he receives. After it's all done in year 15, so just 5 years after he takes that loan out, the loan is paid off. He has $515,000 of cash value. Remember, when he took the loan, he had about 400,000, and now he's got 515. He didn't put a penny into that policy. He just borrowed against it and paid it back. But he's adding no more fuel to the fire. He's adding no more premiums at all. Okay. So that means an increase of cash value. I did the math here, $119,000, but he didn't put a penny in it himself. So that's an incredible yield. It certainly beats my savings account, certainly beats most money market accounts. And even though he paid a little interest, he also got the tax benefits of the real estate, the appreciation of the real estate, the passive income of the real estate. He wouldn't have had that policies growth if he had just paid cash for that real estate deal. And he wouldn't have had all the wonderful advantages of real estate if he had just kept the money locked up in his policy. So I kind of consider this the nitroglycerin strategy here, because you've got real estate and you've got the policy working so well together. They actually work better together than they do by themselves.
That's amazing. And yeah, now he doesn't have to fund it anymore. It's going to keep growing, and now he has what, I don't know, 515, I think you said
Yeah.
519,000
Mm-hmm.
that he's
Mm-hmm.
going to be able to cash value to go buy another even bigger property, and then
Mm-hmm.
continue to keep rolling and rolling. And
That's it.
he's also making more money because he's won the cash flow, and I'm sure the cash flow more than covers the payment back. He's making more on the spread between the two, so he's actually making passive income after paying that loan back to the whole life policy. And then when he goes to sell that property, when the syndication is over, he's making a big chunk on
Yep.
the appreciation. And then he's probably just taken all of that and rolled it into the next deal and the next deal.
Mm-hmm.
And then
Yep.
the tax benefit you mentioned, which we all know in real estate, is the tax benefits are super powerful. So
Yep.
I love that. I love that. It's, it's something I have, in all transparency to everyone, I haven't pulled the trigger on, but it's something I plan on doing in the near future. I just see it's just a no-brainer to me. I want my money working for me at all times, overtime. This is like working, two jobs, at the
Yep.
same time. So
Yep. You're working, you're working that money. You want it working hard for you. It's otherwise they're going to go work for somebody else, your dollars.
yep.
So it might as well work for you. No, let me kind of quickly caution your audience and you, Shawn, as well. Don't just rush out and find somebody on YouTube talking about this. There are 400,000 life insurance agents across the United States. And there's about 1,100 life insurance companies. I wouldn't work with 98% of them. Okay.
Yeah.
Why? Well, are they good people? Yes. Are they smart, intelligent? Yes. Have they got a credential associated with this? No. Almost all of them, no. If you've ever been grocery shopping, seen the USDA organic label on your food you're looking to buy, you may not know all the reasons why they have to put that label on there, but you probably know there's like 20 or 30 steps the farmer had to go through, a certain procedure to put that label on the food. And then you look next to it and there's an all natural version. And what do you know about all natural? Well, it doesn't exactly have any kind of like, credential to it, right? There's no back. It can mean anything. And that unfortunately has become the case with many of the words out there. Family banking, infinite banking, wealth reserve strategies, all sorts of phrases that are fine, but they can sometimes lead you to believe that it's a credentialed process, a training program. When I got my certified financial planner designation, I got it in part because I wanted to give my clients the very best. They deserve that, but also to indicate to the marketplace that I'm not just a fly by night here. I'm thinking through your financial situation from a 30,000 foot view and looking at it from your estate plan, your tax strategy, your investments, your insurance, the full picture, retirement strategy. And that's true with the Bank on Yourself program. There are only about 200 Bank on Yourself professionals in the United States and Canada, Shawn.
Wow.
And they go through a rigorous training process. It took me about 3.5 years to become a Bank on Yourself professional with any sort of aptitude. And I'd recommend anyone listening, if you've heard of this before, look and see if the person you're talking to, if their email signature has the phrase Bank on Yourself professional, or find it on their website or whatever. If it doesn't, you might ask them, but then you might start to research and find one that you connect with well.
Right. I totally agree with that. And beyond that, you want someone who's the best at what they do and are trained on it, and not just having a product that they can sell because it's there. Right.
Mm-hmm.
And also in this product and the insurance product and just financial services in general, you have to be careful when you buy these products because they can often be structured to be more beneficial to the person offering it to you than you, the actual consumer, investor, user of the product. Mm-hmm. And so one of the reasons why I know Mark here is not one of those individuals is because when I asked him the question, what's the cash value I can get within the first year, the number he gave me is far greater than most people tell you. Most people tell you 50%. That's because they're getting paid a lot up front. So that's why you don't have access to that cash value. But Mark is saying 70, 90%. That's massive. That means, yes, Mark's getting paid as he should be. It's his job. He's putting us in a position to win. It takes a lot of work to put these together. But he's not gouging you. And so,
I don't want to retire before my clients do.
Right.
So yeah, you're right. And I do the math on that. And I show to clients, one, because as a fiduciary, I'm supposed to work in my client's best interest.
Yep.
And so I want to and need to disclose that with folks. And second, I don't recommend this tool to just everyone who, calls me or hops on Zoom with me. We do a financial consultation first. I want to listen before I, jump to conclusions. It's a nice tool. Don't get me wrong. I think it should at least be considered by most people, but there's a lot of people who it's not a good fit for. And, I don't just assume that just because it's a neat idea that everyone should run out and go get a giant whole life policy where they're pouring all their money into it.
Right.
You really want to make sure that it's fitting your overall objectives, your risk tolerance and goals. And I think that's really lost in most of the process. And just please don't misinterpret me. There's a lot of good people, but if you don't have the training and the credentials, you don't know what you don't know as a financial professional. And Shawn,
So
I know you
true.
know that in your background, having some exposure to just the financial services world, and that's true with real estate too, right?
Oh, 100%. There's a lot of syndicators out there these days because, they take a course and then, they go try to raise money. And there's nothing wrong with that. I
Mhm.
love America. I love that spirit of entrepreneurship and building your own dream. But as an investor, you have to be careful with that. And it's not to say that these people can't be good at it, but you got to be aware, do they have a track record? And if they don't, are they, partnering with people that do have a track record and a very good record that they can leverage off of?
Mhm.
Yeah, anything you do in life, make sure you do your due diligence. Anything where you're going to place your hard-earned money. But yeah, Mark, I'm really glad you brought that up. I guess my next question is: you mentioned that it's not for everybody. Are there any? I guess what are the top things, or I guess items, characteristics of people that should not, or there are situations that they may be in that they should not be using this
Mhm.
product, at least maybe not at that situation they are in their life.
I would again just emphasize the importance of working with someone. Don't work with someone who just Googled this yesterday or read the book yesterday. You might end up with the wrong company or the wrong contract. A lot of companies will, like I just spoke with someone the other day, they thought they had something like this, and it turned out it was an indexed universal life policy, which increases in its cost every single year.
Oh, geez.
And another guy who thought he had it, but it was going to actually lapse on him, run out of cash, and just burn itself up like in the
Wow.
atmosphere right after he retired in just 2 or 3 years. So you really want to look at that in detail. In addition, we really want to emphasize too that this tool is a cash equivalent. It's not meant to replace your investments. It's meant to be a parking spot in between your investments. Think of it almost like the warehouse of your wealth. When you get the windfall from your syndication, when you sell your rental property, that money has to live somewhere, at least temporarily. So parking it in that policy now allows you to then use that money over and over again and recycle it. But you still have to put the money in there. I just spoke with someone earlier today. He was like, Mark, I got a couple $100 a month and I need to borrow about $1 million for my next real estate deal. And I'm like, you have to put the money in there first before you can access that money. And so having that discussion, realizing that you must be a saver or have a saver's mentality, at least, the idea that you have to think of this as a long-term financial tool, I think is an important caveat. So it's not a good fit for folks who want to get rich overnight, you might say. And then I'd say too, even if you're old or have some health issues, you can still get these policies. A lot of folks wonder about that, and I found that very often, if we lower the death benefit, that's where the expenses and commissions are. So if we can lower that down as tight as we can, you could be 65 years old or 35 years old, and we're going to have a cash value that will grow about the same amount. You'll have the same amount of cash, whatever your age. So I'd say age isn't really a factor, but I would say just think of this as a long-term financial play, and that you do have to save that money. As you get that money put in there, then you're able to use it.
That's awesome. And is there a limit to how much you can, put into one of these plans, maybe in a given year?
Well, I do have folks putting in a couple $100 a month, you know,
Yeah.
and other people putting in a couple 100,000 a year. And one guy's doing about 3.1 million in his policy.
Wow.
So that's one every year putting that in. And remember, this is a tax-free
Right.
design. So comparing this to a Roth IRA, most guys our age can put about $6,000 into a Roth IRA every year.
Yep.
That's 6 with 3 little zeros after it. Okay.
Until we
So
start making a certain amount of active income, then
that's
we
right.
can't.
Yeah. Yeah. Then they cut you off at the knees there too.
Yeah.
So, man, what an incredible way to park tax-free liquid money. I just don't know of really any other place in the financial universe that allows us to do that with those sort of certain tax advantages and still have liquid access to it while it continues to compound. It's just it's a zebra among zebras, which is why I can't get past it, even as
Right.
awkward as it is to talk about life insurance.
No, so yeah, exactly. And to me, and I'm sure to a lot of people, insurance is kind of one of those evil necessities when we think about it on the grand scheme of things. And it's one of those things that our eyes turn usually glaze over, right?
Hmm.
And it's those things like whatever, I need it, but I'm not going to really give it much thought other than signing on where I need to sign and getting it. But
Yeah.
this topic of insurance, to me personally, I'm very intrigued by. And anytime I hear it, my ears perk up, my eyes open, and I am focused. So like I said, it's something I've been looking at for a long time, doing my due diligence, and it's something I will be utilizing because it's it's a powerful tool. Like I said, you grow your money. It's essentially working for you twice
Yep.
if
Hmm.
you're reinvesting the money you take out and the tax benefits, which we all know that's how you truly build wealth. One, you have it working for you when you know when you're not trading time for money. It's working for you when you're sleeping, and then the tax benefit, so you can have more money now. What you mentioned at the beginning of this episode, that time value of money, more money you have now that can work for you for your future. And so, yeah.
And do you want another kind of fun creative application? I've talked about how you can use this to
Yeah,
pay
let's
off
do it.
debt, how you can use it to invest in real estate, fire your real estate banker. Let me talk about another kind of regular tool that gives a lot of people heartburn, and that is property taxes. So especially here in Illinois, goodness. So I had a guy one time who had a $90,000 a year property tax bill that he had
Wow.
to pay among a number of different properties. And so what he did was he said he could save some money into a policy. He wanted to put something away from all the rent he was receiving. So he combined his rent money, okay, about 50 grand, with his property tax money, about 90 grand, to equal 140 grand. He took that 140, dumped it into a whole life policy. All right. And right away, he's got about $100,000 of cash value right from the start and a $3.3 million death benefit. He's about 45 years old. So right away, within 30 days, you can access that money for any reason. So he borrowed against the policy, 90,000 bucks. Okay. So he had 100 grand. He borrowed out 90, almost all of it, to pay his property tax. So cool. Why? Because the policy is still compounding.
Mm-hmm.
All right. And he never pays the loan off. After 20 years, he's just taking loans every year, ripping money, 90 grand every year out of the policy. He's funding it at 140, taking a $90,000 loan. I don't necessarily recommend everyone do this because it does take some digestional fortitude, as they say,
Yeah.
because you built up a nice $2 million loan, let's say. But a couple of things. Nobody is going to come repo your life insurance, okay? And they're not going to report this loan balance on your bank statements, on your credit report. You have no loan. When you're trying to get a loan for like a mortgage, it does not count as your debt to income ratio or any of that. And it's not on your credit report in any way. So it's a private loan with you and the insurance company. But he's built up this nice sizable loan. If he never paid off the loan, Shawn, the death benefit would pay it off when he passes away.
Right. And it sounds like there'd be a premium. He'd still make some too, because there's about 3
Yeah,
million in death benefit, 2 million
that's
in loans.
right.
So there's still a million. And they're
That's
not going to
right.
come, and they're not going to come after the real estate either. So
That's right. Yeah, it's fully, it's self-collateralized. The life insurance
yeah.
policy is self-collateralized by the death benefit. The insurance company knows they're getting theirs someday, hopefully decades from now while we live. But this guy, he never paid off the loan after 20 years, and he
Wow.
still had a $1.2 million cash value that he then turned into a tax-free income in his retirement, in our example here. That's if he never paid off the loan. Property tax and IRS, they're happy. His wife and kids are happy with that income stream. And of course, now the death benefit has grown to 5.8 million, and he walks away and never pays off the loan. That's called a strategy called reduce, pay up. So that's a tool where all of us are paying taxes, property tax, income tax, whatever. Why are we paying cash for the biggest expense of our lifetime? It's unfortunate in the land of the free, Shawn, that our biggest expense is Uncle Sam. We're going to give more to the government than we will our own children, which is shocking to even say that out loud. I mean, you put the word "the" and IRS together, you get theirs, right?
It is theirs.
Right? It's all theirs.
Yeah,
so funny. Anyway, so just imagine how powerful that could be if all of us, even with just your personal residence, you took self-escrow your homeowner's insurance and your property taxes inside your policy. treat it like your own escrow, and then pay your property taxes, at least with your own home. And if you have rentals, look at that as an option as well. Now, more likely, this guy is likely in his real life, he's just getting started on this a few years now, but likely he's going to sell some real estate and get these big windfalls. Where do you think money should live? If you got a windfall of $500,000 and your loan balance on your policy is $500,000, what a great spot to park $500,000 in a tax-free instrument. Even a CD would tax you to leave it in a CD for a year.
And you're making pennies on the dollar.
And you're making pennies, yeah.
And
these
other
policies
benefits.
will do, yeah, you got it, man. These policies will do 5-6 times what a CD can give you these days. So anyway, it's just a neat, very creative tool that can be applied to almost any situation.
Oh, that's amazing. Well, before I get into our 2-question drill, I think I just came to mind right now. That's what I'm going to call it, the 2-question drill instead of the 2-minute drill. But before we get to that, let's can you share with the listeners where they can find you if they wanted to connect with you or learn more about what you do?
Sure. Yeah. If you want to get to know me, you can hear me on Not Your Average Financial Podcast. That's Not Your Average Financial Podcast. You can find us at notyouraveragefinancialpodcast.com. If you want to get to know me through there, you can listen to 200 plus episodes on this strategy, as well as a number of other strategies we get into. Or you can go to reach out to me, and you can go to, again, Not Your Average Financial Podcast. Click on the button that says request a meeting if you'd like to. If you just want to get to know us first and kind of get on our newsletter, go to bit.ly, that's bit.ly/boy real estate. That's BOY real estate.
Awesome. Thanks. So here we go. 2-question drill. Just the inaugural 2-question drill. Here we go.
Love it.
First question. Why? So usually I ask why real estate is one of the best ways to grow wealth.
Mm-hmm.
Let's say, why is whole life insurance one of the best ways to build wealth?
Well, let's put it to an acronym. What do you say? How about TGIF? TGIF.
Let's do it.
All right. Tax-free. Where else in the financial universe is something like this so abundantly able to fund in a tax-free in the future kind of asset? That's an incredible T right there. I could stop right there. That'd be a pretty awesome way to end the episode. G is guaranteed to grow every single year, and the gains you earned last year won't be taken away from you this year. So every year it grows, and the gains are locked in. Unlike Coca-Cola stock, you might get a dividend last year from Coca-Cola, but they'll take it from you this year if the market drops, right? So that's guaranteed is G. I, it is insurance. So automatically I'll leave my family more than I've saved for them in the life insurance policy, guaranteed. That's the third piece. And then finally, F, become your own source of F, financing. Become your own financing by using this policy as a line of credit for all of your major expenses. Now, awesome. I'll just wrap it up with saying, don't just keep the money in the policy, guys. Again, nitroglycerin, Batman Robin, put the money into the life insurance, yes, but then use that policy for things like real estate, which is, I'd say, as old as the pyramids in terms of building real wealth.
Right. It's true. Get that money working for you, and why not get it working for you in double time?
That's it.
You're only going to grow your wealth faster and be able to do the things you want to do with the people you want to do it with. And to me, it's not just that, but them being able to give back to the things that really mean a lot to me and try to make the world a better place. But you need time and money to do those things, and these strategies will get you there faster.
Mm-hmm.
And when I say faster, it does not get rich overnight, like Mark mentioned earlier. That you can go find those strategies on the YouTube advertisements and commercials. But this is get wealthy over a longer period of time, but it's the tried and true method to get there.
Mm-hmm.
And so, yeah, I'm glad you brought that up. And second question, here we go. If you had a time machine, Mark, if you could go back in time and tell younger Mark one piece of financial advice that would completely change his life and set up his life to just create that perfect life of the balance of time freedom, financial freedom, and being able to spend more time with your family, what would that piece of financial advice be?
besides stay out of that bank.
Yeah, right. Take that $50 and run, Mark.
Yeah, that's right. Yeah. Well, I'm thankful. It's a great question. I would say to any of your listeners, the same thing, that potential, the word potential, has such promise to it. And we all want to have great potential. But it's the last thing I want to write on my tombstone. He had such great potential is a shame at the end. So how do we suck the marrow out of the bones of life every day? You've got, if you're in your mid 30s, when you're listening to this, you probably got about 1,900 Wednesdays left on average. If you had $1,900 in your bank account, would you just make sure to watch that money and make the most of it? I want to make sure that I'm putting that money to work, working as hard as I can with that last $1,900 to my name. And I would want the same for my 1,900 Wednesdays I've got left, or whatever your number might be, but based on your age. So the point is, just activate your potential, light that ignition under your butt, and get out there and make something awesome happen for yourself, for your future. The world needs you to.
Yes, the power of compounding, the eighth wonder of the world. Start early and invest often.
That's right.
And use these strategies that Mark and I have discussed today, and it'll get you to where you want a lot faster than you think it will. And it'll actually probably get you way beyond where you want to be. And that's just the power of compounding. And Mark, I just want to thank you for your time. This has been a wonderful episode. I've learned a lot, and I'm fairly certain the listeners have as well. So thank you for coming on here and sharing your knowledge with us. It's greatly appreciated.
My pleasure. Keep up the great work, Shawn.
Thanks, Mark. The listeners, thanks for tuning in as always, and we'll catch you on the next one.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course share it with a friend who needs it. See you next week for another great show.